Because oil crossed $100 a barrel for the first time since 2022, inflation expectations reset, and that reset is now working its way through every rate-sensitive corner of the American economy. Brent crude rose 2.9% Friday to $104.81, up roughly 50% since the Iran war began February 28, when it was trading near $70. The mechanism is straightforward. Higher oil raises headline CPI forecasts, which pushes the 10-year Treasury yield higher, which raises the cost of every long-duration loan in the economy. The 10-year yield climbed 51 basis points since the war's start, and now sits at 4.47%. That is not noise. That is a structural repricing of the cost of money. Capital Alpha Partners analyst Byron Callan puts only 25% odds on the conflict ending by May, and 35% probability it extends into 2027. If Callan is right and the Strait of Hormuz remains contested through summer, oil staying above $95 keeps the inflation yield transmission channel open, and the Fed's next move becomes more constrained, not less. That yield repricing hit the housing market with particular force, severing what had briefly looked like a Trump administration success story. The 30-year fixed mortgage rate jumped to 6.38%, the highest since September 2025, erasing the sub-6% window that had opened in February. Mortgage applications collapsed 10.5% in a single week, and refinancing activity dropped 15%. The mechanism here is compounding. Not only did rates rise, but rising oil prices are squeezing consumer budgets at the same time, making buyers simultaneously less qualified and less confident. The White House had unveiled a package of housing measures, including a 50-year mortgage proposal, designed to revive affordability. Those measures are now fighting against a macro tide they were not designed to handle. Separately, the Build America Buy America waiver bottleneck at HUD, where hundreds of affordable housing projects are stalled waiting for material exemptions, is adding supply-side friction on top of the demand-side shock. If the war extends and Treasury yields remain elevated above 4.4%, the spring homebuying season is likely to be the weakest in years. Meanwhile, a different mechanism was at work inside the technology sector. A leak about Anthropic's new cybersecurity-focused AI model, reportedly called Claude Mythos, triggered a sector-wide repricing of competitive risk for established security platforms. The logic investors acted on: if an AI-native model can automate threat detection and response at scale, it commoditizes the differentiated product layers that Palo Alto Networks, Okta, and CrowdStrike charge premium prices to deliver. Palo Alto Networks fell 6% to $146 Friday, a stock already down 19% year-to-date, despite posting 14.9% revenue growth and beating EPS estimates in its last quarter by nearly 10%. Okta's drop was sharper in context. The company had just turned its first full-year GAAP operating profit, but guided for only 9% revenue growth in FY 2027, and that deceleration makes it structurally more exposed to competitive narrative shifts. The Anthropic leak has not been officially confirmed, and the actual displacement risk may prove overstated, but the market is pricing in the threat before the product exists, which is typically how AI competitive repricing works. Zooming out, the session's headline number was the Nasdaq sinking more than 10% below its record high, officially entering correction territory, while the Dow fell into its own correction, with an accelerating chance of a Fed rate hike now priced in by prediction markets for the first time this cycle. The transmission from war to markets runs through two channels simultaneously: energy costs hitting corporate margins directly, and inflation expectations cutting off the rate cut path that growth stocks had been pricing in since late 2024. Consumer sentiment is breaking down as well. Gas prices averaged $3.98 per gallon nationally, up $1 from a month ago, and that kind of household-level price shock tends to produce a rapid confidence decline. ARM Holdings fell 5.8% Friday, even after surging earlier in the week on its CPU announcement, with Moody's Analytics now placing recession probability at nearly 49% over the next 12 months. Meta extended its weekly losses past 11% following a landmark negligence verdict over youth safety on its platform, an independent legal risk that compounded the macro pressure. If oil stabilizes below $100 and the Hormuz ceasefire talks gain traction, the market's inflation narrative could reverse sharply. But if April 6 passes without Iran reopening the strait, Trump's threatened destruction of Iranian energy plants would send crude toward $150, which BlackRock's CEO has warned would trigger a global recession. Not everything moved in the same direction. Memory stocks staged a counter-trend rally Friday, with Micron rising 2% after announcing it had begun mass production of HBM4 chips for Nvidia's Vera Rubin GPU. The significance is structural. AI memory demand is driven by a dedicated supply chain that is largely insulated from consumer discretionary slowdowns. Micron reported $23.9 billion in revenue for its most recent quarter, nearly triple year-over-year, and its debt-to-equity ratio is a remarkably low 0.15, despite committing $100 billion to a new semiconductor plant in New York. SK Hynix's chairperson has stated the AI memory shortage will not resolve until 2030, which means the demand backdrop for Micron exists independently of whether the Iran war depresses consumer spending. The countertrend here is meaningful. It suggests institutional money is still finding AI infrastructure a conviction trade, even inside a macro-driven sell-off. 3 watch points define the week ahead. First, the Iran ceasefire talks. Trump's April 6 deadline for Iran to reopen the Strait of Hormuz is now 8 days away. If talks produce a framework, even a partial one, oil could retrace $15 to $20, Treasury yields would fall, and rate-sensitive sectors, including housing and growth stocks, would stabilize. If talks collapse and the U.S. launches energy infrastructure strikes, Brent moves toward $130, and the Fed's rate hike scenario accelerates from prediction market speculation to consensus. Second, Tesla's Q1 2026 delivery report, due by March 31. Polymarket places 62.5% probability on deliveries in the 350,000 to 375,000 range, and an additional 29.5% probability on sub-350,000, meaning more than 90% of prediction market capital is positioned for a soft print. A miss would push TSLA further below its 20% year-to-date loss, while a surprise beat would test whether the SpaceX IPO narrative is enough to trigger a sentiment reversal. Third, the Levi Strauss Q1 report on April 7. UBS analysts expect a modest beat and steady guidance, but note management may turn more cautious on macro given oil prices. At $18 per share, against a $33 price target, the stock is pricing in significant downside. If guidance holds and the company signals pricing stability, it offers a read on whether mid-market consumer brands can absorb the oil shock without margin compression.